What is up, YouTube? Eric here, Mr. Fired Up Wealth. A new month here, April, and you're wondering, what stock should I buy now? What should I buy in the month of April? What's going to go higher from here? Eric, what do you think? Every month I try to do these, guys. I try to bring you some stock picks, at least 5, sometimes 10, sometimes 12. Today I'm going to bring you 10 stock picks. I'm going to give you a variety, some hyper growth, a little dividends in there, DGIF. You're definitely going to want to check this out. These are going to be great ideas for you to explore, do your own due diligence, your own homework, but you're going to want to see these picks. I own all 10 of these stocks. I think they're going to go higher from here. Stay tuned. All right, so today we're going to look at 10 stocks. This first one I have to get off my chest because I'm kind of fired up over it. And these aren't in any particular order, but the first stock that we have to talk about got a downgrade today from price target from 148 to 115, and the stock's down about 5%. And that stock is AMD. So AMD is actually the first pick that we're going to talk about today. It's trading actually at $113.60. This downgrade, I don't agree with it, especially, and I'm going to tell you why. Before I do that, this is Fidelity's new website. They've just kind of updated this. So there's a lot of new information on here that's pretty cool. You know, it shows you the 52-week range. We had $72.50 back in May. Of course, this was before the Xilinx acquisition. They've had some really strong quarters since then. The high on this thing was $164.46, ended in November of 2021. Pretty much the top, most growth is considerably lower. Now, this isn't cheap by any means. It's still trading at a 46.32 P ratio. But when you look at the quality of this, the balance sheet and the growth, I still think it's a buy at these levels. I've said for a while, if it gets close to $100, especially $100 or less, it's a buy. 113, still attractive, and I think you need to watch this one in case it goes lower. I want to cover this analyst downgrade. Before I do that, short interest, 1.71%, so that's not too bad at all. And if you remember, there's a video I just did on AMD, talks about why I think it's a buy. One of the reasons is that they have a stock repurchase plan worth $8 billion. And I think that's going to help create a floor closer to that $100 range on the stock. Now, I want to go through this really fast just to give you the key takeaways. This is a Barclays downgrade, and Blaine Curtis is the analyst, downgraded it to equal weight from overweight and dropped the price from $148 to $115. It's now trading below $115. But of course, price targets are 12 to 18 month targets. So he's saying in 12 to 18 months, it's going to trade basically the same levels it is now. And I don't agree with that. I think this could easily be a $150 stock in the next 12 to 18 months. So here's what he's saying. The company's growth story needs a pause with cyclical risk looming in 2023. Says that AMD is positioned to gain market share in both client and server markets this year. And this is why I'm really bullish, because of that Xilinx acquisition, unlocking synergies between the two businesses. I think there's a lot of opportunity in the data center. So it's not just gaming for AMD anymore. You got to think data center, think big picture here. He's saying that all these segments are running at elevated levels and that they need a pause, that the growth trajectory needs a pause. And he goes on to explain more, risk with GDP, lower than expected GDP data, rebounded oil prices, and so on. Now, he's saying it needs a pause, it needs a correction. We just had one. The stock was $164 and it came down to close to $100, I think $99 and change at one point during these lows, and it's trading at $113. So, I mean, this is a significant drop from $164 down to $100 a share. We've already had that correction. So for me to say it's going to be worth $115 in 12 to 18 months, I disagree. I think it's a buy here, but I think you need to watch it, because if it gets closer to that $100 level, that's where I definitely think that it's going to be a buy in a long-term hold. But even at these rates, guys, not bad. Dollar cost average, try to get it $100 or less if you can. So based on that chart there, can you guess what stock this is? This thing absolutely just ripped all the way to $400, and it came below $100. It's trading at $113.75. P ratio is an 80. Now you look at that and say, 80 P ratio, that's crazy high. The growth on this thing is out of this world. Check out the growth on this company. So this is at a $9.59 billion market cap, which I think has lots of room to grow. This is just the last quarter, year-over-year revenue up 247%. And oh, by the way, we have 19.3% profit margin. Go back another quarter, 242% with 12% profit margin. Do you guys know what stock it is yet? June, 896% year-over-year growth with 19% profit margin, 81% and 8.5, and so on. This was a new IPO, basically the end of 2020. Of course, the stock is Upstart, and we have several videos on Upstart that go deeper dive. So check out the channel, make sure you subscribe. Check out the AI, the artificial intelligence series. This stock is on that series. They're a cloud-based artificial intelligence lending platform. They're trying to replace that FICO score. They're getting more and more into auto loans. Check out the total addressable market here on auto loans. Quick Motley Fool article here. Fellow fool Jamie Luco, I think is how you say that. March 28th, check this out. How big is this opportunity? Upstart Auto is working in a massive market. The loan origination opportunity in auto is worth $727 billion annually. So the company's $1.5 billion in loan volume guidance is peanuts compared to its potential. And if you've watched any of the videos we've done on the channel about Upstart, we talk about how there's a lot of segments they could actually chase after, but they don't even need to really do that. They can stay within the segments they're at. Just auto loans alone is enough to fuel this company's growth for many, many years. So I'm very, very bullish on Upstart. I believe it should be worth at least $150 right now, right here, right now, based on those growth metrics. It might be it probably is the best growth opportunity that you could buy at these current levels. In my opinion, I believe that. Upstart, right now, it's trading closer to $100. If that thing gets below $100 again, in my opinion, no brainer to buy that stock. It's trading at $113.75. So you could have obviously bought it in the $70 range not that long ago, but I still think that it's attractive. I'm not saying it's going back to $400 tomorrow or anything, but I believe this stock's worth at least $150, and I think it's still a buy right here, dollar cost average if it goes lower. All right, the third stock, can you guess what it is based on the chart? Another really ugly chart here, dropped from over $350 down to $117, trading right now at $117, down 4.73%. The low on it was $85 on March 15th, so a lot of these have bounced pretty high from the lows, but are still very, very suppressed from their highs. And I'm not suggesting any of these stocks are just going to rally back to all-time highs. All-time high on this was October 19th of 2021. It was $372, and now you can buy it at $117. Of course, that's C limited. And there are some fears about this, 8.2% short interest. It's being traded with the Chinese ADRs as a whole, which I don't necessarily agree with, but Tencent does own about 19% of C Limited still. And there's some risks with growth. When you think of their gaming platform, you think of the whole India risk, and you know the whole story behind that. Free Fire, huge platform, seeing a little bit of slowdown in the growth. This is that three-headed monster. You've got the e-commerce, you've got the fintech, and you've got the gaming. And they certainly have hit a speed bump. They did get, expensive, maybe ahead of themselves. I want to show you the price to sales ratio on this since it doesn't have a PE ratio. So C Limited right now is trading at a 6.28 price to sales. Now, if I look at the historic chart on this, and it doesn't necessarily mean that it has to go back to these levels or anything like that. We're just looking at where it's been and where it might go and where it might be an opportunity to add to buy. Of course, you don't just look at a price to sales ratio and buy. There's lots of other homework that you have to do. This is a quick video giving you 10 stocks rapid fire. In the past 5 years, you can see down here, the minimum on January 3rd, 2019 was a 4.4 price to sales. The maximum was February 19th. We had that really euphoric run early 2021. It got out to almost a 31 price to sales, which obviously is way too expensive. You'd probably agree. But right now it's trading at a 6.288 price to sales. And if I look at a 5-year chart on this, we're basically back to 2019, 2018 type levels, end of 2018. And, if you go back to 2017, it was trading at 10.73. So, obviously if the growth is slowing down, you look at it and say, well, we're not going to pay as much premium, but this company still has really solid growth. Let's go look at the growth metrics from the last couple quarters. So this is a $65 billion market cap. You can see the year-over-year growth, 105.68%. It doesn't have, the earnings, so no P ratio, negative 19.17 net profit margin. Of course, these type of stocks don't do as well in this type of environment. Look at the previous quarter, 121% growth, negative 21%. 158%, negative 19%, pretty consistent, solid growth. 146% growth here with negative 23.97 and so on. So, you look at the numbers, it has really solid growth for a 6 or 7 price to sales. And I think it's a buy at these levels. I think it's going to go higher over time. Could it go lower, retest $100? It could. And you would definitely dollar cost average, I think, in that position. I believe it's being punished more than it should be because of its exposure to China and really being traded into the China ADR bucket. And I think a lot of those might be already overdone. And this one is unjustifiably sold off more than I think it should be. Cash and cash equivalents, guys, $9.25 billion. This company, I don't think is going anywhere. I think it's a nice long-term opportunity if you're thinking, 5 and 10 years out. It's based in Singapore. I think it's a good stock to buy. I think it's buy at these levels. Definitely check out C Limited.
We're sorry. Your call cannot be completed as dialed.
So the fourth stock on the list, can you guess what this is? 52-week range, $546, and looks like $12.43 for the high on 11/4/2021. And it just made a massive bounce. It was $700 not too long ago. It's $1,100. And you say, well, it's ran too hard, too fast. That could be true. But Tesla, guys, here's the thing. There's only 2.9% short interest on the stock, okay? The PE ratio is 222. That's really expensive. It really is. If I look at this company, though, and I look at all the secular growth trends, when I think of autonomous driving, electric vehicles, artificial intelligence, this is probably the top AI stock. NVIDIA and Tesla are the two top artificial intelligence stocks in the world, I believe. And so I would have much rather have bought this stock, of course, at $700. If you're buying this stock at these levels, you know that it could go back below $1,000. But this does have momentum. If the market stays bullish, I think this actually can go as high as $1,300 even in the short to mid-term. And I believe that this stock will still close the end of the year higher than where it's at now at $1,100. I did add some of this at $700 on the recent sell-off, and I felt pretty fortunate on that. Of course, I went long in 2020, and I've done really well on this stock. It's expensive. It's a $1.13 trillion market cap, but they've been opening up the gigafactories. They've been expanding. You could have a 3-hour conversation just on Tesla, and we've got a great channel in Discord. Derek and several other people manage that. Tons of great due diligence on there. If you want to check out our private community, go to Fired Up Wealth Patreon. So just Google Patreon, Fired Up Wealth, or you can check the link in the description of this video below and check it out. Join us for a month. Give it a try. If you don't like it, cancel anytime. But April's a new month, so check us out on Patreon. Tons of information in Discord on Tesla. I'm very bullish. The community is very bullish. You have to be careful at these prices, but I still think it's a buy, especially if you have a long-term horizon, 5 or 10 years. I believe this stock's gonna be worth a lot more than $1,100 a share. This next one is DJIF, and you'll never guess what it is in a zillion years. And you look at it and say, well, why do I want to buy it here? It just ran to all-time highs, $420. The 52-week range is $320 to $437.98. Now, it is trading a little bit lower today. P ratio is still only at 23.04, pays you a 1.01% dividend yield, basically no short interest at all, less than 1%. And of course, I'm talking about John Deere. And you say, why would I buy John Deere at $417 when I could have just got it in the low 300s not long ago? This stock was consolidating. It ripped really hard. It consolidated for quite a while. In fact, if you look at a 5-year chart on this, a 2-year chart actually, excuse me, you can see how it's just consolidating here. This is a channel, and it's just consolidating in that channel. And I believe it's going to break out and create a new channel. There's a few reasons for that. Of course, part of the reason, and this is not to be insensitive or anything like that, but it has been somewhat comical. Every time you see a video or something on Twitter with the Ukraine-Russia, war, you see like a Russian tank basically being pulled by a John Deere tractor. You got the green and yellow tractor. So that's been, kind of crazy. But the main reason I think this is still a buy here, number one, it's a high quality company. They have autonomous tractors. There's all kinds of great technology. So I really think of this, it's an industrial, but I look at it as a tech stock in the industrials. It's like the Tesla of agriculture. And I did a video not long ago that did like a 30-minute deep dive on why I think John Deere's a buy when it was, $325. And if you bought it then, you're really happy because you've done really, really well with the stock. But I still think it's a buy, especially if it goes any lower, below $400. I definitely think it's a buy. And here's why. So these tractors are expensive, and they do have supply chain risks, and commodities are more expensive. But the people that are buying them are farmers, and they're making bank right now. When you think of corn and grain, the prices are really high. They're going to have a lot of extra money. And if you're familiar with how farmers work and how their businesses work, they're going to apply some of that capital into the business, especially if they want to kind of lower that tax burden if they're making a lot of money per bushel. So you're going to probably see, for a few different reasons, you're going to see farmers upgrading their equipment. Number one, they're going to be making more money. Number two, they want to be more efficient and more effective, and these new tractors can do that. And a lot of them haven't updated their machinery for a little while because they've been suppressed with some of the prices, and they haven't done as well. So anytime you see a surplus of money, a surplus of wealth, there's always spending. We just saw it with the stimulus, where a bunch of people got money and they bought, Bitcoin and stocks and meme stocks and all that. It's kind of the same effect. Farmers are going to have more money, more disposable income, and they're going to spend it on equipment that not only helps their business, makes it more efficient, more effective for years to come. So John Deere is still buy at these levels, especially below $400. This stock might not be the most popular on my list, but I am bullish on the stock, and you may not agree, and that's okay. Now, this was a $307 stock back in November of 2021, November 26th, and it got down to $109.38 February 24th. So that's a pretty major correction. P/E ratio is a 40. So again, this is a high quality company that has earnings, and the stock is actually Etsy. It has 8.3% short interest, so it's a little higher than some of the ones we've seen prior. And it doesn't pay a dividend, anything like that. But the growth, I'm going to show you the growth here in a second. The risk of that growth, of course, is the hard comps. You got pandemic comps. And so this might, be taking a breather for a little while. Under $125, in my opinion, this stock has a buy, a 40P ratio. It's trading at 129. So if it gets a little bit lower, I think you dollar cost in, anywhere from $110 to $125. It's probably pretty solid support at that 109 previous low. And a couple things to note on this. So Matt Payne brought this up in the group, said that they're basically raising the prices for sellers by 30%. So that's a little deceiving because it doesn't mean the sellers are paying 30%. It means a 30% increase. So from 5% that they're paying Etsy to 6.5%. So that has caused the stock, it was starting to rally again. It has caused the stock. Part of the reason I think maybe it's pulled back a little bit is from that news. Now I think about that, Patreon charges 10 and 12%. YouTube, if you sign up for YouTube membership, they take like 33% or 30% of our revenue. So if I'm an Etsy seller and they're taking 6.5%, Apple takes 30% from the App Store. I don't think 6.5% is that bad. And they've created this huge network, this huge environment for sellers to thrive in. 6.5% for what they're getting. It's improved over the years, and they're getting more bang for their buck. And I think it's worth an extra 1.5%, even though it's a 30% increase on paper. That seems like a scary number. 6.5% overall isn't bad. I don't think it's bad at all as a seller. And at the end of the day, I don't think it's going to impact Etsy's business. If anything, it's just going to help them be more profitable because now they're charging an additional 30%. So as an investor, I see this as a really bullish thing. So this is not like a hypergrowth stock or anything, guys. 16% year-over-year growth. This is where I was talking about the hard comps from the pandemic. They sold a lot of masks, things like that. But here's the thing, guys. These guys are profitable. You saw they have a 40P ratio. 22.53% net profit margin. It's a $17.09 billion market cap. And if I look at previous quarters, so 17% growth, 18%, that's pretty good, not bad. 16% on the net profit margin. I go back 23%, 18%. So they don't have hyper growth based on those comps, but now look at this, March 2021, they had 141% year-over-year growth during the pandemic, and they had a 26% profit margin. So if I look back at some of the other comps, during the pandemic, they had this massive growth spike during the pandemic, and now they're going through those comps. So if I look at the other side of that, I look at 12 months out, I think this stock starts to do really well, and I think it's worth a lot more than $120 a share. I think this easily will be a $200 stock, sometime in the next 12 to 18 months. So housing has started to slow down. Interest rates are going higher. So there's fears about some of these companies related to home improvement. The stocks are getting hit. Now, if I look at this stock, it's a 19.8P ratio, and that's actually really inexpensive for what you get. It pays you almost a 2.5% dividend yield, and this thing was $420, now trading around $300 a share. The 52-week range on this, the low, was actually 6/18/2021. So we're going back, 8-9 months to get to that low. And guess what we're trading at today? $303, only $5 higher than the 52-week low. If this thing gets below $300, Home Depot, so Home Depot's the next stock. If it get $300 or less, I think this is a solid buy. It's not expensive here. And here's my thesis on it. Even if rates are high and housing slows, you have to remember Home Depot not only supplies materials for new construction, they also are a home improvement store. If rates are high and I can't afford another house, I can't afford to upgrade or to move, I might remodel and improve the house I'm already in. And I've owned a Home Depot for many years, and I've had this discussion many times as I've owned it about like, oh, the housing market's going to slow down, it's going to hit the stock. And it never does. And the reason is it flourishes on both sides of that. Even if you get into a really bad environment in the housing market, these kind of stocks like Home Depot still do okay, because I might just say, hey, I'm going to stay in this house. I still like it, but I'm going to go spend $50,000 on a kitchen and a bathroom remodel. Well, Home Depot might benefit from that. They sell appliances. They sell all the construction materials to do that. So anytime this stock gets below 20 PE ratio, in my opinion, when you look at the market, the overall market is trading at a premium. You think of the S&P 500. This is not a stock that should be below a 20 P ratio when the rest of the market, the forward P ratio of the S&P 500 is over a 20 P ratio. That's my opinion, and I think this stock is a buy $300 or less. So pick number 8. Look at your screen here. What stock am I talking about? It was $1,762.92, November 19th, 2021. The low is $510 on March 14th. It literally lost $1,250 a share, from $1,762 a share to $510 a share. Short interest is still about 3%. P ratio on this is a 30, and there's acquisitions in there. It's questionable if that number is correct. I hear different things on that, like the P ratio is not right because of this and that. So take that with a grain of salt. Forget about the P ratio. Let's look at the growth, and let's look at where the stock's been. Look at the price to sales ratio and get an idea of where it's been historically. This is a market cap of $88 billion, and the stock, of course, is Shopify. Now you look at Shopify and say, well, this is still really expensive at $700 a share. Maybe it is, but I'll tell you what, if I'm holding this for 5 years, I'm accumulating shares, between $500 and $700, me personally. And I think it's still a buy at $700. Let's look at the price to sales to see kind of where it's been. So I'm looking at this saying price to sales never should have been over 60. That's too high. Right now, the price to sales ratio is 19.19. It's still expensive. I'm not saying it's not expensive. Okay. So what I'm saying is if the stock goes down and retests $500 level, I think it's a buy. I still think it's okay buy at $700. And I know a lot of you aren't going to agree with me, and that's fine. But I do believe this stock will be worth a lot more in 3, 4, and 5 years. So we might be playing different games. I'm a long-term investor. If you're looking for a quick buck, hear me say, this might not be it. This might not be the one. But if you're an investor thinking 2025 to 2030 timeframe, and you look at the prospects, the cool thing about Shopify is they're basically a SaaS model, but they also have that fintech model where they're making 2 to 4% on every transaction. And it's very scalable. It can help small businesses, medium businesses, large businesses, everything in between. This thing, the minimum in 2019, January 3rd, 2019, it got to a 12.78 price to sales. The maximum was 63.9, you can see below me here, on September 1st, 2020. And right now it's 19. So it got down to a 14.22 on March 8th. That was kind of low. I think if 15 or under price to sales ratio on this stock, I think I can justify it. Let's look at the growth on it really fast. Now, one thing I have to point out is that these guys have a SaaS model, so they have recurring revenue, and that does give it a premium. I think a lot of people get confused by that. They want to compare this to some other companies that don't have that. Like a Mercado Libre, for example, the margins are different and they don't have recurring revenue. So you have to keep that in mind. So this is another one that maybe has some tough, pandemic comps. So I look at this is not great. 41% growth, negative 26% profit margin. This one here though, 46 and 102. Some of these acquisitions made this goofy. 56% and a 78% profit margin, 110%, 127% profit margin. There's been some really impressive numbers on Shopify. And I believe that this company is still in its infancy. I think it has a lot of room to run. It can compete against, Amazon. It's really the next biggest footprint when you think of e-commerce traffic and sales. And I think they have a lot of room to grow, especially internationally. So this is a long-term investment, very long-term. It's not a a short-term trade. If you believe in this company and you're holding it for many years, I think it's going to be worth a lot more than it is now, but it's still expensive and it's probably not one of the most popular stocks on the list, but I like it. Shopify. So another COVID play, another pandemic winner has fallen from the sky. And it actually went down to $97.91. It was almost $500. It was a $490 stock last year. It went from $500 to $100. It's been beaten up pretty bad. Short interest is 6.95%. It does have earnings. It has a P/E ratio, 76, so it's expensive, but it does have some nice growth. Of course, the stock that I'm talking about is another one that might not be popular, but I think it's going to go higher. Roku. Now, of course, if it gets to 100 or less again, that's where you want to buy it. But here's the thing. It's going through some tough pandemic comps, like a lot of these stocks. And if you're thinking 12 to 18 months and you're buying it at these levels and accumulating shares, I do believe that this company will be worth more. This is another one that could easily go back to $100. And if it did, I think it's a strong buy below $100. These guys do have risk when you think of supply chain because they do make hardware. So the Roku devices, the remotes and stuff, right? But the advertising segment has a lot of room to grow. And I believe they're going to get past some of those supply chain issues the back half of this year. So this might not be one that's a short-term deal again. It might take many months for it to recover. But I would personally, if I can get my first lot below $125, maybe I buy half or a third. If it comes back, you kind of know the floor is probably $100. So you've got a 25% range from $100 to $125. And you're really trying to fight a cost basis in that range, I think, between $100 and $125. I think the stock will be worth over $200 in 12 to 18 months, which is, here's the thing. It doesn't have to go back to all-time highs to make a lot of money. $490, I don't think it's going to go back there anytime soon. It doesn't have to. If it goes to $200, you're making a lot of money if you're buying it at $125. That's a really solid return. In fact, if I do the numbers on that, even if it only got to $187.50 a share, that's a 50% return if I'm buying it at $125. So this is one where you have to kind of look past the noise. Everybody, when there's blood in the streets and everybody's telling you that this company is going to go out of business because it's a pandemic play, there's no future, no one's going to, is nobody going to stream TV anymore? Is Roku dead? It does have competition, but I'm telling you, this is one that's going to be worth more than $125 over time. And maybe I'm wrong. I'm not always right, but I look at risk, reward, and possibilities. And I think this has a high possibility of being worth a lot more than $125 when I look at 2023. So Roku, guys, is number 9. Check it out. Streaming, advertising, ad tech. I do like it. It's a little bit riskier than some of these other stocks, but absolutely just beat down and one that you should check out. So the 10th stock, guys, another one that has a P/E ratio, but an expensive one, but it has earnings, okay? It's got a good balance sheet, 83.51 P/E ratio. The chart, you can see it got hit from 181 all the way down to $106.79 just recently here on March 15th, and it's trading right now at $121. This stock, guys, hear me out. It's Wingstop. And I think it could be the next Domino's. I've been saying that for a while. I've been seeing a couple articles recently, but I've been saying this for a while. Like a year ago, I did one comparing it to McDonald's and Domino's Pizza. And this is one of those compounders. It pays a dividend. It pays a nice little dividend yield, 0.57% dividend yield. They're paying a special dividend, I believe, of $4. They paid a special dividend a couple years ago for $5. They take care of their shareholders. And here's my thesis on Wingstop. Number one, they're trying to grow. They're trying to grow internationally. Now, one possibility they've said before is that China alone could have 1,000 stores. Now, I'm not suggesting that that's baked into the price or anything like that. If they had 1,000 stores in China, the stock could be worth way, way, way more. They don't have to have 1,000 stores in China for this stock to do well. But they're going to continue to do expansion. The risk with that, of course, is that you're going to have higher interest rates, higher material costs right now, so it's harder for them to grow stores. But their footprint is small. They're very focused on digital ordering, and I do think that this is the best restaurant stock if I'm long-term investing. This is another one, again, this is not really necessarily a trade. It's something that's going to take years For me, it's like a 2025 and beyond type story, probably 2030. You're going to start to see acceleration and compounding if you're reinvesting those dividends, and I think it'll be worth a lot more. You know, it was a $181 stock, arguably way too much. It's come down. It's still expensive at 83P ratio. A couple more things I want to cover just so you have the whole picture on this one. So part of the reason the stock got hit, guys, and that came down is their CEO stepped down, and that is a big deal. So the CEO, so it's the chairman and chief executive officer, Charlie Morrison, he took a head position at Salad and Go. And so this just happened here, you know, March 14th, which is part of the reason why the stock sold off really hard. They tried to do that special dividend, I think, around the same time to kind of, you know, keep investors from selling off too hard probably. So there are some risks with this stock. Their vision is to become a top 10 global brand. And you look at some of their annual highlights. I mean, they have 1,731 global locations, 7 different markets. They've been expanding in UK, different countries. So net new restaurants in 2021, they added 193 restaurants. The unit development growth, 12.5%, and so on. One of the other key drivers, of course, of why the stock has sold off is the earnings haven't been very good because they're getting hammered with inflation on chicken wing prices. Now, chicken wings are 65% of what they sell. So they have a very simple menu. It's like, I've got these flavors, I've got wings. They've done some interesting things like tried to sell thighs. So they started calling themselves Thigh Stop and selling thighs because chicken wings were outrageously expensive. And they've done a good job trying to take care of investors and try to do the best they can through the situation. I think chicken prices are going to start to come down in the next 12 months. And because these guys have bargaining power and they've done a great job of navigating a very difficult situation, I think they're going to thrive on the other side of that. You know, the risks are the CEO replacement's a big risk, and then, you know, more expensive for interest rates and materials and things like that. But as those prices come lower, I actually think these guys will do well. And again, it's a long-term story. So if you're buying this stock here, you're dollar cost averaging, and you're thinking, you know, 5 and 10 years is a DGIF type stock. So Wingstop's the 10th one. Please subscribe to the channel if you haven't. Hit the like button, drop a comment. I appreciate your time and attention. Have a great rest of your day. Take care.